Thank you for this opportunity to speak today. My name is Scott Judds, and I am a heretic. I admit my addiction to trend-following algorithms, and I believe we can break through the efficient frontier. But I know I'm in good company today because if you believed buy and hold diversification was the cat's meow, you wouldn't be at a computerized investment seminar on Saturday. Today, I'll show you how I got hooked on trends, that trends are real, and that risk and return are not mutually exclusive. I'll show you there is an optimum trend extraction method, and that trend periods and algorithms do matter. I'll show you how to build great strategies and portfolios, and that backtesting and optimization aren't just adult video games. I'll show you stock screening and analysis still play a role, and finally, I'll show you can do this in your spare time without a PhD. It all started when I discovered I had a problem. After what was called the go-go 80s stock market, I noticed that it went up over 100%, but my IRA funds were flat. I read no shortage of newsletters. Each had great reasons why they were right, but there was certainly no consensus. I watched the CNBC talking heads, and they managed to have 8 simultaneous different opinions. It then occurred to me that my coffee cup really was right. If the nation's economists were laid end to end, they would point in all directions. It turns out this is a fundamental truth. If there were not equal numbers pointing in opposite directions, the market would quickly adjust and make it true. Because experts do point in all directions, they are inherently only a 50-50 crapshoot for market prediction. And I didn't think 50-50 was going to help. So I concluded that these guys are all just a soap opera. I listened carefully to my financial advisor, who hypnotically said, "Diversify and rebalance." To me, that sounds like, own a little bit of everything, and I can achieve precisely average performance? Average? Was that my goal? But I noticed that these same industry giants don't achieve average with their own money. $100 million days? What's that about? How do you get some of that? With no apparent value in newsletters and talking heads, I wondered, what about the data? Does recent market data hold clues for future prices? In other words, do price trends exist? I knew I could answer this question if I could get some data and do some experiments. In 1992, I bumped into one of Fast Track's ads in the Wall Street Journal and subscribed. I exported 3 years of data for 11 Fidelity mutual funds to this Quattro spreadsheet. I set up a few coefficients to calculate monthly trend correlations and used them to select the best fund to own for the next month, and concluded, trends exist. For 1989, 90, and 91, it was showing about a 40% per year return. I was pumped. I was hooked on trends. I started development in the early 1990s with software written in DOS. Then I called it Profit Taker. Everyone needs a spare time hobby, you know. In 2004, I started redesign for a Windows environment and renamed it SectorSurfer. Many features were added, including, in 2009, the StormGuard feature of SectorSurfer was developed to separately deal with moving to cash during major market downturns. In 2009, Some Growth Strategies was formed to bring SectorSurfer to market. This chart is typical of what you see online today. In short, in a SectorSurfer strategy, you select up to 12 ticker symbols to participate in the strategy. The trend algorithm picks which one to own now, and it emails trade alerts, typically 3 to 5 times per year. I said I'll show you that trends are real, which means the markets are not efficient. Let's review the efficient market hypothesis. Paraphrasing, it says, prices already reflect all past publicly available information. One cannot consistently achieve returns in excess of average, and stock and other asset prices follow a random walk model. If true, diversification is best. But if trends are real, the efficient market hypothesis is false. Notably, we're all here because we want to achieve returns in excess of average. So let's examine more proof that trends are real. Shortly after I began development, I ran into a fundamentally important book, Chaos and Order in the Capital Markets, by Edgar Peters. He discusses the rescaled range analysis, developed by Edwin Hurst in 1907, for the Nile River Dam project for water flow analysis. Hearst thought he should know the character of the Nile River flow before designing a dam. Fortunately, he was in Egypt, where there was 2,000 years of data. Hearst showed in this plot of the rescaled range analysis that river flow statistics were much different from that of a random walk, represented by this blue line, and that this difference was representative of its trend characteristics. Apparently, the way storms flow over the tributary collection basin makes river flow statistics non-random. Edgar Peters decided to apply this analysis to the capital markets. For the math geeks among you, the rescaled range is calculated as the average over the entire timescale, left to right, of the maximum range in the interval n, shown by r, divided by the standard deviation of the data over the time interval n. When plotted for the S&P 500 on a log-log scale, it looks like the black line. If the data was a totally random walk, it would be like the blue line. And if the data was a linear trend, it would be like the green line. What we see is that for longer time intervals, it is much more like a random walk, but for shorter time intervals, it clearly shows it contains trending characteristics in much the same way as the Nile River data. The slope of the line is called the Hearst exponent. Okay, that was a lot of geek speak, but here's what to remember. The same trending properties are seen for individual stocks, Japanese stocks, U.S. Treasuries, and even economic indicators. Here the S&P 500 is shown decade by decade, one plot overlying the next. This stability and character over time is called statistical stationarity. Its character remains stable in spite of depression, world war, politics, and technology. Market data reactions are really only about human reactions to new information. How long to believe, to buy in, to be afraid, or to take action. As a population, this character is baked in our genes. Thus, stationarity should be expected. Other evidence that trends exist can be found in this nice article in The Economist from January 2011, entitled Momentum in Financial Markets: Why Newton Was Wrong. The article contains these two charts. The left one is a Credit Suisse study regarding British shares chosen for performance in the past 12 months and showing that the top 20% well outperformed the other groups. The right one is an AQR capital management study for U.S. shares conducted in a similar manner, showing a similar outperformance of the top 20% ranked stocks. Further evidence that trends exist can be found in this industry white paper from Columbine Capital. It cites prior work by a number of researchers and, of course, how Columbine further improved the algorithms with their own secret sauce. Columbine publishes performance charts for a handful of models and sells data to capital management companies. This is their combination model. I've annotated this chart to show two lines of constant return to put them into perspective. The green line is the top 10% of sorted stocks, and the red line is the bottom 10% of sorted stocks. I'm told the subscription for this data is only about $20,000 a year. Finally, this peer-reviewed academic paper by Jagadish and Tietman from 2001 likewise demonstrates that trends exist in market data. In their paper, they divided the stock market into 10 portfolios, grouped according to their prior 6-month return, then held those stocks for 6 months and repeated the process. They found that portfolio P1, the upper 10% of the momentum sort, produced an average return of 1.65% per month, while the portfolio P10, the lower 10% of the sort, had only about 0.4% return per month. That's a significant 16.8% per year difference. So trends are real, and this is what they look like. Here, fund prices are plotted on the top, and their corresponding price trends are plotted below. They are plotted against time, and thus they are time domain data. Remember that term, time domain data. When the price of the orange fund is rising the fastest, the value of its trend is the highest. Thus, the best trend is our friend, and therefore time domain data is also our friend. Yes, trends are real. Trends are, by definition, a portal to the future, where something in the past tells us something about the future. Thus trends are, in fact, the crystal ball we all hope to find. In fact, we are not limited by average performance. I said I'll show you that risk and return are not mutually exclusive. But let's review. Modern portfolio theory says one must trade risk for return. Let's check it out. Modern portfolio theory says if you have a risk-free money market fund here in green and other available investments over here in blue, then the best you can do is to construct portfolios along this efficient frontier line in red. In fact, modern portfolio theory says you can't make long-term portfolios in the upper left of this diagram. According to modern portfolio theory principles, market prices are Gaussian distributed. Rational investors trade risk for return. Risk is measured as standard deviation of return. Risk is reduced by owning uncorrelated assets. And the efficient frontier is the set of best portfolios. But SectorSurfer thinks otherwise. On this risk-return chart of an operating strategy, it is the additional use of trend-following algorithms that enables SectorSurfer to live comfortably in the forbidden corner. Let's revisit those MPT tenets. That market prices are Gaussian distributed fails to consider the tails are way too fat in the real world. This is why 30-to-1 leveraging by banks was not safe. That rational investors trade risk for return fails to consider that new tools change the game. In a sword fight, Indiana Jones reduced his risk by bringing a gun. That risk is measured as standard deviation of return fails to consider that big returns aren't a bad thing, and this misrepresents risk in the decision process. That risk is reduced by owning uncorrelated assets fails to consider temporal avoidance as a method of risk reduction. And that the efficient frontier is the set of best portfolios fails to consider that the efficient frontier might be an artifact of unfortunate self-imposed constraints caused by discarding time-domain trend information. Our poor MPT guy on the left says, "Can you help a poor cripple? I cut off my time-domain leg. I don't know what to do next." Statistics is the only leg he has to stand on. Modern portfolio theory mathematics are completely statistically based. Gaussian distributed, standard deviation, uncorrelated assets. Without time domain information, you have no trend information. Without trend information, MPT is limited to buy and hold. This is why MPT can't pick anything to own or avoid next month. Let's solve the problem. We want to know how to use the blue investment options to create a red portfolio, to simultaneously reduce risk and improve returns. Modern portfolio theory says we can't get there with diversify and rebalance, but let's give it a try and see. I'm going to use the desktop version of SectorSurfer for this demonstration. The vertical axis is logarithmic such that a fixed percentage return per year makes a straight line, as shown by the gray 10% return line. I've created 5 simple synthetic funds, each with a slightly different average return, and each with a slightly different sinusoidal undulation to simulate uncorrelated assets. Their average returns vary from 5% to 9%, and the sinusoidal undulation period varies from 135 days to 229 days. The upward slope of each undulation is 30% per year, plus the base level average return, so 39% per year for the orange fund. The risk-reward chart stacks these dots appropriately like this. Risk here is measured as the coefficient of variation. If we take these uncorrelated assets and diversify and rebalance as shown by the control in the lower left, using an equal 20% allocation for each and rebalancing quarterly, where these are the rebalance indicators and rebalance dates, then it produces the results shown by the yellow line above. With this concoction of uncorrelated signals, there are periods of time when they work together and other periods when they work against one another. On the risk-reward chart, the result shows that we have achieved the average of the returns, and as expected for the uncorrelated assets, the risk is reduced by the square root of the number of participating funds. Conclusion? Diversify and rebalance improves risk, but not returns. Diversification didn't cut it. Let's try trends and own only the trend leader. Let's first look at trend-following mechanics with a very simple example. In the upper black chart, we have a simple sinusoidal fund in green, a pretty flat money market fund in purple, and the strategy results in yellow. In the lower chart, we see the short-term trend indicator for the green and purple funds indicating whether the fund is making money or losing money. A trend-following algorithm says we should own the fund that has the most positive trend and thus most likely to do well next month. Thus, the yellow line goes up when the green fund has a positive return and should be owned, and bails to cash and goes flat when the money market fund is doing better. On the risk-reward chart, note that we have moved left and up at the same time. Now let's do trend following with all of those sinusoidal funds we saw before. First, we'll zoom into a 2-year interval where we see the synthetic sinusoidal funds above and their corresponding trend indicators below, and where each yellow hash mark indicates a trade to a new fund when it becomes the trend leader, and producing this result by owning only the trend leader. If you think of these funds as market sectors, we are literally surfing from one sector to the next, hence the name SectorSurfer. This is called serial diversification, owning many funds, but only one at a time. As this chart shows, one can simultaneously achieve higher returns and lower risk by owning only the trend leader. Yes, this is the Holy Grail. But something is missing. Real markets have noise. Market noise makes our crystal ball foggy. Thus, the game is to extract trend signals from noisy market data. This is the hard part of the job. I said I'll show you that there is an optimum trend extraction method. Fortunately, I went to engineering school at Stanford where I studied signal processing theory, had a long electronics design career, have numerous issued patents, and even authored an optical sensor book. My career has been all about digging signals out of noise, and that's the problem before us today. It's all about reducing the noise to better reveal the signal. Seeing even a little bit of the road ahead is a good thing. There are two primary tools a good signal processing engineer would use. First, matched filter processing to optimally shape a noise filter, and second, differential signal processing to eliminate common mode noise. Warning, there's a bit of geek speak ahead. Consider it entertaining background material that you don't have to remember. We'll start with matched filter processing and its Wikipedia definition. A matched filter is the optimal linear filter for maximizing the signal-to-noise ratio in the presence of additive stochastic noise. This means the best filter shape matches the signal shape. Consider this radio spectrum signal in the frequency domain. A matched filter would be shaped to match the spectrum of the signal like this. Consider this time domain signal leading to an event. If we have many such examples of the event, we might find a correlation signal before the event, like what happens before an earthquake. In the time domain, a matched filter has an impulse response that is the mirror image shape of the correlation signal. So, what is the event? That depends on the problem. Let's say the problem is wanting to know, should we move to the safety of cash? We want to estimate market performance for next month. The method will use the S&P 500 index to represent overall market health. Negative returns are, of course, an indicator of poor market health. So then the event is next month's return. Thus we must find the correlation between next month's return and the returns from the series of days prior to next month. This is that correlation. The horizontal axis is the number of days preceding the event, and the vertical axis is the correlation of the data to the event, with recent past days on the right and far past days on the left. It has near zero correlation for days immediately preceding the event and grows to a peak a few months back in time. So again, we're looking for a filter with an impulse response that looks like a mirror image of the correlation between the event and pre-event data. This is the correlation between the event, which is next month's return, and the pre-event market data. Let's look at 3 candidate filters, 2 well-known and 1 not so well-known. In green is a 50-day simple moving average filter. Its impulse response is flat for 50 days and then goes to zero. In red is a 50-day exponential moving average filter, quite popular in market data analysis, declining exponentially to its 1/e point in 50 days. And in blue is a 50-day second-order exponential moving average filter with a humped impulse response. It clearly looks the most like the mirror image of the correlation data. Let's check it out. When you run the correlation data through these filters with different time constants, we see that it is true that the second-order exponential moving average filter in blue performs much better. StormGuard uses the 50-day second-order exponential moving average to decide when it is time to move to cash. These plots show the returns of numerous SectorSurfer strategies versus different time constants for the filter. Their performance peak at about 50 days is not an accident. The market pullback in the summer of 2010 was StormGuard's first real-time test since its creation. The StormGuard indicator chart on the right shows that StormGuard came close to triggering a move to cash, but did not. The bottom chart shows that, in the larger perspective, when compared to serious market downturns, StormGuard made the appropriate decision. However, 1 year later, in 2011, the U.S. debt downgrade and a threat of collapse of Greek debt scared the market a bit more, and for a short period of time, StormGuard did trigger a move to cash. Although the natural instincts of many people is to want to pull the trigger to go to cash much quicker, it's important to remember that there is an optimum balance. React too fast, and you suffer from whipsaw losses when sharp drops often snap back, and react too slowly, and you will get hurt if it really is a major market collapse. Let's look specifically at how StormGuard affects strategy performance. This is a Fidelity sector fund strategy. The green line includes StormGuard, the yellow line does not. The benefit of StormGuard comes exclusively during the two major down market periods in this 23-year chart. The cumulative strategy improvement achieved by including StormGuard is 86%. This second example is a Fidelity country fund strategy. Again, the green line includes StormGuard and the yellow line does not. Again, the benefit of StormGuard comes exclusively during the two major down market periods in the 23-year chart. The cumulative strategy improvement achieved by including StormGuard here is 65%. In summary, one can use matched filter theory to first identify the signal leading to the event, identify the filter having a mirror image impulse response, which optimizes the algorithm response and actually produces results worthy of our attention. Next, let's address differential signal processing to eliminate common mode noise. This chart has a dozen broadly diversified funds, each of them with a slightly different focus. It's pretty clear that there's a lot of common mode market noise within each of them. If we take two mutual funds, a finance sector fund and a healthcare sector fund, and do the usual correlation calculation over time, we see this blue line telling us they have a lot in common. However, when a 60-day moving average filter is applied to the data to remove short-term common mode noise, we see something entirely different. These negative correlation spikes are periods when longer-term fund trends are opposite one another. One fund is increasing while the other is decreasing. There's no good reason to own both funds. Diversification does not justify owning bad funds. Detecting trends is what it's all about. Let's take a step back and first examine solo signal processing, which means making a decision by looking only at a single fund. In this case, Fidelity Medical Delivery, FSHCX, is plotted in green above. The red line is a money market fund. Here, our investment rule is that we will own FSHCX whenever the trend for its daily return is higher than that of the money market fund trend, and own the money market fund otherwise. There are 10 little yellow lines on the bottom chart, each indicating a trade from one to the other. The results of these trades are shown on the top chart by the yellow line. Clearly, performance is poor, primarily because it is too often the victim of whipsaw losses. We need a second fund to do differential signal processing. Let's use Fidelity Electronics, FSELX, shown in red. But first, let's look at the same solo signal processing treatment. It too suffers whipsaw losses and has at least 10 trades, including this burst of indecision trades. However, when FSELX and FSHCX are played against one another to eliminate their common mode noise from the decision process, the results are completely different. Now there are only 3 trades. Now whipsaw losses have disappeared and the trade decision results are spectacular. An electronics engineer would diagram it this way. First, you apply a matched filter designed to optimally extract the trend signal. Then you apply a differential comparator to eliminate common mode noise. The result is a decision of what to own right now. High-performance Ethernet and USB signal processing is done this way, and for good reason. In summary, it's not a solo contest, it's a horse race. Change horses to stay on the fastest horse. It's fine to change horses in the middle of the stream, but don't get whipsawed. Trend periods and algorithms do matter. But which trend is my friend? There are lots of time periods, and there are lots of algorithms. Let's revisit the Jagadish and Tietman academic paper and ask which trend is my friend. Their choices were, for trend algorithm, the simple moving average. For averaging period, 6 months. For repeat interval, 6 months. That sounds pretty constrained to me. As an engineer, I want knobs. I want to turn all of the knobs, and I want the knobs to go to 11. What happens when we turn the knobs? I picked a Fidelity sector fund strategy and plotted what happens when turning 2 of the knobs. On the bottom is the simple moving average time constant. On the right is the trade interval. And this circle in the center is where Jagadish and Tietman focused their academic paper. One might conclude that this red line hump for 1-month trade intervals and a shorter SMA time constant would have been a better choice. On this chart, we'll keep the red line from the prior chart and we'll turn a different knob. We'll keep the 1-month trade interval, but on the right we can try different kinds of moving averages, with the SMA simple moving average in red, the EMA exponential moving average in black, the second order EMA in blue, and the third order EMA in purple. It kind of looks like they all have a pretty good zone of performance over here. But not so fast. Let's expand our scope and see if stocks, ETFs, sector funds, and country funds all behave the same. The chart for these 4 strategies all use the SMA simple moving average. Particularly when looking at what happens to the red line in these 2 places, it wouldn't seem to give much hope that the SMA can be relied upon. But now, let's again keep the red lines from the prior charts and keep the 1-month trade interval. But again, we'll try different kinds of moving averages. In every case, the second order and third order EMA produce a nice peak. Yes, trend algorithms and time period do matter. I said I'll show you how to build great strategies and portfolios. This involves serial diversification, which applies to true sector rotation and asset class rotation. And it involves post-surfing diversification, which applies to individual stocks and commodities. See, I actually love diversification. Well, if it's the right kind and in the right place. One occasionally sees charts such as this that tie market cycles to economic cycles. Along the top are market sectors that are said to benefit at various stages of an economic cycle. The stages of an economic cycle are identified along the bottom. This, of course, speaks to the concept of sector rotation. If we draw a wave cycle for each of the market sectors, the sector rotation model might look something like this. If one then makes an analogy to an engine, where each sector wave is analogous to a piston in an engine, then the smoothest and most powerful ride from the engine will be when all pistons are sequentially firing and there are no missing power strokes. That's exactly why this strategy with only 5 Fidelity sector funds performs so well. The sector pistons it contains are medical delivery, energy services, electronics, multimedia, and consumer finance. True sector rotation is the practice of serial diversification, owning only the one best sector fund at any time. This Federal Thrift Savings Plan strategy inherently practices asset class rotation because of the nature of its funds. For its pistons, it has the U.S. Common Stock Index, International Stock Index, Small Cap Stocks, Fixed Income Index, Government Securities, and a handful of balanced life path funds. Asset class rotation is the practice of serial diversification, owning only the one best asset class at any time. Before I address post-surfing diversification for individual stocks, I would like to review the prudent investor rule, which basically says to put no more than 20% of your portfolio in any one investment. Seems like a pretty reasonable guide. Netflix is the poster child for why this is important. The top blue line on this chart clearly shows the risk reduction value of owning at least 5 stocks at a time. I want to contrast methods for risk reduction. ETFs and mutual funds use dilution via broad diversification. SectorSurfer strategies for funds use dilution via sector diversification, and they use avoidance via serial diversification. SectorSurfer strategies for stocks use avoidance via serial diversification, and then they use dilution via post-surfing diversification. But what does post-surfing diversification mean? I've picked 4 SectorSurfer stock strategies. The first is called Vice Squad and contains stocks from companies trafficking in alcohol, tobacco, firearms, and gaming. The second one is called Bleeding Edge and contains stocks of internet, biotech, and electronics companies. The third one is called Weekend Warrior and contains stocks of home repair, recreational vehicles, and sporting good companies. And fourth, one called EIEIO and contains farm equipment, farm products, fertilizer, and seed companies. With post-surfing diversification, we surf first to capture the returns, then diversify to reduce volatility. This is the portfolio performance chart for those 4 strategies, each weighted at 25%. The yellow portfolio line is visually smoother than for the constituent strategies, and the yellow portfolio spot has moved farther to the left. This is post-surfing diversification. In summary, diversification method matters. Here's a pop quiz for you. In what ways does surfing and diversification explain the chart's clear pattern? I said I'll show you that backtesting and optimization aren't just video games, as will be demonstrated by split sample stationarity and progressive tune stationarity. We'll start with split sample stationarity. In this strategy, clearly the first half and the second half of the 23-year time interval have dramatically different price performance of the constituent funds. However, if the character of the trend data that SectorSurfer uses to make its decisions actually does have stationarity, then we should find that the optimum parameters for each half are the same. Plotted here is the annualized return versus the second-order exponential moving average days for the full 23-year period in green, the first half of the period in red, and the second half of the period in blue. While it is understood that the returns during the first and second halves would be different, the important takeaway from this chart is that the location of the peak in each period is roughly at 17 days. Independent of market performance, trend character remained the same. Hence, we have split sample stationarity, because optimum parameter tuning was consistent over time. Next, we'll examine progressive tune stationarity, a more rigorous test. The SectorSurfer desktop application includes an auto-tune option for progressively tuning the strategy. As illustrated here, during strategy sequential data processing, every 125 days it pauses and reassesses the parameters used by looking back 250 market days and then nudging the parameters a little higher or a little lower according to what appears more optimum. Then these parameters are used for the next 125 days, and so on across the time span. Progressive tuning produced the nice results shown on this chart. Here is the track for the progressively tuned parameters for the strategy. The second-order exponential moving average days above, and a parameter called hysteresis along the bottom. Remarkably, both parameters are quite stable across the 23-year time span, despite the market excesses to the upside and downside. Here's a comparison of the strategy using progressive auto-tuning on the left and the same strategy tuned by hand in hindsight on the right, showing remarkably similar performance. Here's the takeaway about stationarity. With stationarity, backtesting is about identifying the trend character of the data. Trend character is agnostic to market direction and price pattern. And if you tune your strategy well today, tomorrow it will still be tuned. Stock screening and analysis do still play a role, but remember, it's not a solo contest, it's a horse race. So we need a set of horses for the strategy. That's where a screener might help. We've recently introduced a stock screener on our website. It's a bit different. It's not about presenting a list of stocks to buy right now. The objective is to select a set of qualified stocks to participate in a SectorSurfer strategy. The strategy algorithm will make the final selection. The most important qualifications are that the trend correlates well to future returns, that the stock has shown recent signs of life, and that it has low volatility to improve success of swapping horses midstream. The SS rank value is a composite of those three values and does not include any consideration of these other interesting but largely irrelevant parameters. Here is a strategy consisting of the first 12 stocks listed by the screener when sorted by SS rank. As you can see, the 3-year return in yellow is much better than that of the S&P 500 in white. Alternatively, if we do a reverse sort on the trend quality and then pick the first dozen stocks listed, we get an entirely different result. In fact, the trend character of these stocks is so bad that SectorSurfer does worse than anything else on the chart. Screen for the right things. Further to the topic of analysis relevance, dividends are always interesting. I'm sure most of you have seen plots such as this one showing a correlation between dividends and returns. Let's look closer. The chart on the left has a 10-year observation period and the chart on the right a 1-year observation period. Given that you're in a computerized investment seminar, one might ask, is the 10-year chart relevant? Let's cut dividends another way. This chart shows dividend yield versus 3-year excess return. Why 3-year excess return? Because only stocks that are beating the S&P 500 are relevant. Let's break through the noise a bit and average 100 similar dividend stocks. This is what was hiding in the scatter plot on the left. It suggests that better returns can be achieved from lower dividend stocks, even when dividend adjusted. So, if you seek better returns, are dividend-paying stocks relevant? Make sure you screen for the right things. Indeed, you can do this in your spare time without a PhD. In fact, let me introduce you to my mom. She uses SectorSurfer. She's 84 years old, has a journalism degree, and still blogs online for the community newspaper. Mom helped us make sure SectorSurfer was as automated and easy to use as possible. If she can do this, so can you. Let's go online and see just how easy it is. Here is the home page. It has 5 summary topics, one associated with each of the 5 graphic panels. You can click each of them to drill in for more information. Below we have hot buttons regarding different kinds of investments, further resource information, and steps for getting started. But let's log in. I am already logged in, so it takes me directly to the My Strategies page where all the action is. Here I can see I have 1 active strategy and 1 sandbox or experimental strategy. The active strategy is called Columbia Mixed and is composed of these 12 mutual funds. Click the chart icon to see all the performance measures. This strategy averages 17.7% per year return, has pretty low risk by 3 measures, and was born on July 7th of 2010. It averages 3.9 trades per year. Click the Trade Signal History icon to see the trade signals this strategy generated in the past. You can download all the strategy performance measures in Trade Signal History to a spreadsheet for additional analysis by clicking this button. Click the Information icon to change the strategy name, change the minimum hold time setting, get its strategy ID, or add notes about the strategy. Here is where you see the most recent buy and sell information and acknowledge your trade. Now I'll click the Select a Strategy button to import another strategy. We can scroll down the list, or I can input some text here, such as Fidelity, to see a list of only Fidelity strategies. I note here there are some free strategies and premium strategies. Let's take a look at this Fidelity Income Bond strategy. Its chart looks pretty good. Let's close the chart, click Use Selected, and take that one home with us. In just moments, it shows up on the strategy page, and you can view its chart here. It is now one of my strategies. Now let's build a custom strategy from scratch. We'll start by clicking the first ticker symbol position to bring up the Find a Fund pop-up window. And let's enter a part of the name of a mutual fund, such as Magellan. And we see Fidelity Magellan is top on the list. We'll highlight it, click Use Selected, and Magellan comes onto the list. Click the second position, and this time let's enter the ticker symbol directly, FSELX, for Fidelity Select Electronics. So we click Use Selected, and it joins our strategy. Let's enter a third one, another mutual fund, Multimedia, FBMPX. Use Selected. Let's check to see how the chart for this is doing so far. Starting to look pretty good. Let's just add another fund or two, such as Energy Services, FSESX. Use Selected. And how about a financial one, such as FSVLX, Fidelity Consumer Finance, and a healthcare, such as FSPHX. Couple of good sectors in a general purpose fund. Let's see what they make. Not bad. Let's put our own name on it. Call it Scott's Trial Strat. And we'll set it to trade month end, and the notes will be Scott's third IRA. Save. The name and notes appear. We'll check the chart to see if the name is on the chart now. It is. We're good to go. And that's all it takes to build a strategy from scratch. In my email, I've received a SectorSurfer trade alert for my demo account. So we'll click the login button and go to the site and see what needs attention. I told it to remember my login, so it takes me right there. There are 2 trade alerts on this page. The first one says to buy KSU for a new strategy just implemented. So you click the link for your brokerage, go make the trade, and then return here to acknowledge the trade by clicking the red button. Yes, we want to acknowledge the trade. The trade acknowledgement history can be seen by clicking the green H icon. There's our trade. Strategy number 3 says to buy dollar weight. Let's click the trade advice icon to see what that means. It says this is a new strategy, and it has specified to buy FBMPX. Since the short-term trend has gone negative, SectorSurfer recommends waiting for an upturn or the next trade. A new trade alert will be emailed then. Please acknowledge $weight by clicking the red Acknowledge Trade button. We'll do that. Acknowledge the trade. The button turns green, and you're done. Now that's pretty simple. Let's review. I showed you that trends are real, that you don't have to trade risk for return, that there is an optimum trend extraction method, that trend algorithms do matter, how to build great strategies, that trend stationarity exists for backtesting, that stock screening plays a role, and that even my mom can do this. It's automated and it's easy. So, break through the efficient frontier. Our servers will do the hard work while you go have a life.